time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
The listener is Tom, and he is interested in learning a little bit about Decisive Dividend. We're going to take a look at this company. This is a company I've looked at in the past for our income research, so I'm somewhat familiar with it. It trades on the TSX under the symbol DE, trading right now at $5. It's a $73 million market cap company, and it currently pays a yield of over 7%. So what they do is they are an acquisition-oriented company focused on manufacturing. They identify other companies in the manufacturing industry that they acquire. They bring those companies into their portfolio and then manage them. Use the cash flow to pay a dividend to their shareholders. And then ideally, the objective is to grow those dividends over time. They have 7 companies in their portfolio right now. Companies like Blaze King was one of the original names in 2015. This is a wood and gas stove manufacturing facility. They have companies that operate in different markets, including agriculture, energy services. This is a stock chart for the company going back to 2013. You can see the performance over that period of time has actually been pretty good, and the company has been trending up recently. It's one of the outliers actually in the market right now. It's been performing quite well in 2022, which is a rarity these days. Very good financial results for the last quarter, growing the revenue 57% to almost 26 million. Adjusted EBITDA increased 118% to just under 4 million. Earnings per share of 15 cents, an increase of 275%. And they also reported free cash flow per share of 19 cents compared to negative 16 cents or loss in the previous year. So these numbers look very good. A couple of comments from the CEO about the quarter. During the quarter, we achieved record quarterly operating results for the second straight quarter. So 2 strong quarters of operating results. He also said that each of our portfolio companies continue to experience strong demand for their products, as demonstrated by our record revenue levels and robust growth. So good, strong performance across the business. They made an acquisition earlier in the year, which helped growth, and they're also in the process of closing another acquisition right now. Taking a look at the balance sheet, they have about $37 million in debt, net debt to EBITDA multiple of 3 times, and debt to equity of 1.55 times. So I think this balance sheet is okay. The leverage ratios look okay. I might say, just given the small size of the company, I mean, it's a micro to small cap right now. Maybe the leverage ratio, net debt to EBITDA, is slightly high. I might be a little more comfortable at 2.5 times, but 3 times is certainly reasonable. It is a manufacturing company. I just wouldn't want to see it balloon up to 4 times or higher than that. But as I said, I have known this company in the past. I've looked at them before, and there's one thing that I have noticed about them that is not something that I want to see from a company that I'm potentially going to invest in, and that's that they don't really have a sustainable track record of growth when it comes to free cash flow per share. So looking at the free cash flow per share going back to 2016, there's some ups and downs, volatilities, a couple of years where cash flow was basically break even. A really strong year in 2020, but there was also some government support there during the pandemic with the Canadian, the CEWS, Canadian Employment Wage Subsidy. I can't remember what it's called. But
CEWS, yeah.
Yes. CEWS. It's been a while since I've seen it, but that also did benefit them in 2020. So if we were to look at just the dividend sustainability, really nice yield of 7.2%. It has come up recently. They have increased the dividend, but only up to the pre-pandemic levels, because they did reduce the dividend during the pandemic. But if you look at the payout ratio, very healthy for the third quarter. But when we look at for the 9 months of the year, payout ratio of 168% based on free cash flow, our calculation of free cash flow. So that's concerning, to say the least. So what is our take on Decisive Dividend? Well, we do think it's an interesting company. They have an interesting portfolio of different businesses and very strong financial momentum over the past couple of quarters. But that free cash flow is certainly concerning. They don't have a track record of consistent free cash flow and sustainable growth. and the payout ratio as well for the 9-month period is concerning. So this is a situation where we think that it warrants deeper investigation, but it's not something that we're going to run out and buy right now. Even though the numbers look good, they have great market support. If those quarterly numbers continue, the stock should end up doing very well, but we want to just continue to follow them. And that's a bit of a segue into me talking about some research that we are starting right now, and that will be the 2023 Canadian Dividend All-Star Report. So this is where we look at every dividend paying company in the Canadian market. We do research on every one of them, and then we provide a very vetted list in the report of the companies that we think offer the best value based on dividend growth in cash flow, general competitiveness of the business and the business model. And that is going to be out before the end of the year. So Decisive Dividend will be part of that research, and who knows, at that time we might gain some more perspectives.